And the Shanghai Composite 2 is trading above the flat line with gains of around 0.3%.
20 days, the first resistance, which is 24,436.
Probably the best that we've seen in all the FMCG companies that have reported their numbers so far.
It's 24,223 on the Nifty. The Nifty bank is starting about 0.3% higher.
The interest in India still remains very, very high.
6 months, the demand has not worked out in the way we were expecting.
Essentially, a company which works with the US health insurance sector.
The picture across the benchmark indices is flat.
Overall slippage in the system for FY25 would be around 7,500 crores.
We are being a little bit cautious in terms of how would this Q3 pan out.
7th or 8th consecutive day that the rupee touches a fresh low.
Markets give up intraday gains and extend losses as sensex falls over 800 points from the day's high.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Well, that is the day so far, and it's been a tough day with the market under pressure. Through the course of the day, from the beginning. I mean, actually, only the opening was good, and after that, it's been down and out. 200 points almost lower as far as the Nifty goes. This is Closing Bell. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, hi. Good afternoon.
Hi. Good afternoon,
Morning.
Folks. I guess morning. Really?
Afternoon.
We've made it through most of the day. No morning. But jokes aside, I think today's a session that the bulls will be watching very, very carefully, because we're only 100 points away from the recent low, which is about 23,800 odd. And we just, like I'm saying, just about 100 points away. The issue here is that it's not just India today. A lot of global markets have been weak. Look at markets like Hong Kong. Hang Seng's down almost 3%. Europe is trading down about 1% or so. So I guess it's not only a India situation or India-specific red screen. There's some cool-off after the Trump trade. Good afternoon, Nigel.
Well, good afternoon. That's right. All of a sudden, suddenly the Nifty bank is the one that's dragging in today's trading session, but it's still holding on to the 51,000 odd mark. And the Nifty, well, it's broken that initial support zone. Look at the options data of around 23,950 as per the options data. So we'll see whether or not it wants to go ahead and retest the recent lows at around 23,800, or it wants to go for a visit to around the 200 DMA. Mitesh Thakkar is with us though. Mitesh, well, it's a fairly disappointing trading session, right? Because you were hoping that we'll see another couple of days of consolidation, then try to make a bit of a drift up. That's not to be. Are we breaking down? Mitesh, yeah, please go ahead.
So I think the earlier lows, are the key criteria to figure out if we are breaking down or not. And the low which we got, if we, were to go back to hourly charts and it was 23,850. I think there is a chance of us breaking down and head towards, the 23,500, 550, 600 zone, because that's where the 200 averages, that's where the weekly historical support pivot is. So good chance that we might do that. The way to trade the index could be, if you want to assume a stop about 24,060, get into some bear spreads, because naked shorting at such, with such a big decline at which has happened in the last 2-3 weeks, I think may not be the best idea. So that's how we'll approach the market, do some bear spreads and see, if the market continues and breaks 23,850, then you might get a good profit in the split positions.
Mitesh, what would your stock calls be?
I have a sell on Canfin Home Finance with a stop at about 847 for targets of 800. And we'll take a contra call on BEL. I think actually this pattern there is very good and the stock is now close to support areas. So keep a stop at 288, look for a target of 305.
I just want to make one point, which I think is is important. So the market, of course, is, and the graphics will come up on your screen. We're, of course, below the sort of support zone 24,000 to 24,100. That's what we highlighted in the morning. But the dollar, I think that's the only new kind of reason I can spot earnings, etc. We know. I mean, it's not new to the market per se. But even compared to where the dollar was at 8 o'clock when we started this morning, it's up another 0.25% from the 8 o'clock level. So I think, in a 24-hour cycle, we've moved from about 105 to about 106, almost 105.85. And I think that perhaps, apart from sort of all the old reasons, which is earnings and whatnot, I think this is a bigger reason as well, which is, of course, impacting not just the market here, but some of the sort of other markets as well. China, I mean, take that as an example. Look at the Chinese currency and what is happening there. The rupee, of course, has been at a low, but the CNY has also been under pressure with the USD actually making a move higher. Of course, I mean, there are sort of country and currency specific reasons as well. So we could talk more about that. The next resistance for the dollar is the 2023 high, which is 106.52. And this 0.25% rally from just over the last few hours means that we are a little closer to that than we were when we started. And the 2024 high is 107.35. I think these are the next levels that the dollar index will watch out for. I just wanted to put that dollar point on before we go any further. So keep an eye out on this one. Important for flows and important for markets as well. Let's talk about individual names here. Britannia is under pressure. It's the top nifty loser on the back of numbers and, of course, management commentary on the conference call as well. Mangalam is here with details. Mangalam.
But Britannia was down 5% ahead of results, and this morning opened lower. Thereafter, post the conference call, saw a bigger decline and is now among the top nifty losers. That's largely because of three key points that came in from the conference call. The first one, they expect some impact on the volumes in the short term because the last few quarters, the company has been seeing volume growth of anywhere between 6 to 8% going forward with reduced grammage as well as, increased base. There might be some impact. Demand scenario is still not as robust as it's been in the past, and they will obviously try and balance both volume as well as price going ahead. To that, they are carefully monitoring the volume and price situation over the next 6 to 9 months, as a result of which they have also initiated some focused pricing action in specific channels, and at the same time, they are vigilant of competitive pricing action. So no inspiring commentary coming in from the conference call, and that has led to a big decline in the stock price for Britannia today.
Okay, all right. Here, Britannia's taken it on the chin once again. 5% yesterday, 5% raise, 10% drop. More than that, actually. Look at that, 7% decline coming through today. We'll discuss this with our experts, both technical and fundamental, in just a bit. But let's also talk about happier things, Mangalam, and that's Jubilant FoodWorks. I don't remember the last time and which quarter it must have been where Jubilant actually came out and pleasantly surprised the street. So what has worked here?
It's about 11 to 12 quarters since, Jubilant FoodWorks came out and pleasantly surprised the street. This time around, what has actually worked is the core of their business, which is delivery. It's actually doing well. So if you look at the standalone numbers, compared it to the poll, you won't see a much big divergence from what the street was anticipating already. Even on the like-for-like growth front as well. The company's reported 2.8%. The street was working with 2 to 3%. One would say, what's so new out here? The good part is if delivery, which accounts for nearly 70% of their revenues, saw 15.9% growth, and dine-in, which is structurally seen a slowdown, continued to weaken. In delivery business itself, the like-for-like growth was about 11.4%, and that's a marked improvement from what we've seen over the last many quarters. Quick service restaurants not doing particularly well over the last 7 to 8 quarters, now seem to be doing well. The other thing that's working for Jubilant FoodWorks is also this is one of those rare companies where the leaders actually done a lot better than the second or third rung companies, as against the others that we've seen in the case of, say, something like an Asian Paints and others as well, where the leader was the underperformer. The challengers were a lot better. Here, the leaders led from the front and done a lot better, and the street's rewarding it.
Okay, absolutely it is. So no to cookies and biscuits, yes to pizza. That's the market verdict this time around on these two stocks. Thank you for that, Mangalam. Let's go across to our first guest on the show. Deepak Shenoy, founder of Capital Mind, is joining in. Deepak, great to have you on. I don't know if you eat cookies or pizza or both or neither, but the trends are very interesting. Let's start first with Britannia, and then we'll get your take on Jubilant and maybe even Asian Paints. But what do you think? I mean, is this just a short-term patch? Or are there bigger issues at play here?
I think, Surabhi, the problem is valuation. You value the company that is growing 8% on volume in a good time at 56 times earnings. At some point, you're going to have this disappointment that how do you kind of, make sense of the valuation numbers when you can't grow significantly more from here? Of course, I'm not a big fan of, cookies or pizza for that matter, but health issues aside, investing is amoral in that sense. So, but I think the bigger thing over here will be a layer of competition, the change in the structure of, we've already seen this with DMart and Reliance Retail and all that, talking about change in the volume from, say, quick commerce players and so on. What this specifically does, the quick commerce setup, is changes the inventory holding from the end consumer who used to buy a lot of biscuits earlier to perhaps the Q-commerce dark stores and perhaps the distribution where, inventory constraints remain. Your house has real estate for free that is owned. That is effectively what the Britannias of the world will use to effectively store their goods if you buy for, say, a month at a time. But if you buy that because the delivery is in 10 minutes, there is an inventory problem that surfaces earlier up in the distribution chain. So that does affect things in the longer term. I don't know if it's affected them now, but I think at some point that volume growth changes will kind of affect them. And that may be, a temporary 2 or 3 quarters while that kind of sets itself in place. However, I'm not a big fan of these companies at these valuations. If they're at 25, 30 times earnings, I think that's probably a better time for me to kind of pick them up. So not really fond of staples per se.
Okay, all right. Hi, Deepak. Good afternoon and good to see you in. Deepak, the problem for the Nifty is that the two opening batsmen, so to call it, HDFC Bank and Reliance Industries, one of them is off form always. Even today, you have HDFC Bank that's down. Reliance is holding mildly higher. Now, on Reliance Industries, I wanted your take. Last 6 months, actually, the stock has seen a bit of a correction. And, there are a lot of players out here. You have the petrochemicals, oil and gas, retail, you have telecom, everything's in there. What's your take, after the recent underperformance? Is it come to a level that you want to chip in?
We have very big holding, Nigel, in Reliance. So I'm very biased in that. It's probably our second or third largest holding. But one of the things that has always been our thing has been the demerger of the businesses is what's going to unlock value. And that's not happening right now. All the businesses are under some level of pressure. You're seeing retail pressure happening in general across the markets because of lower growth, lower same store sales growth, and in general, the pickup in terms of a lot of the items that they're selling has not moved meaningfully in the September quarter, causing them to kind of flag it. Though they are doing some operations. Jio has also started, I think, retail operations. Reliance Retail does, I think, 10-minute delivery now. I saw a pilot of it taking off very recently. So they may also be getting in on that act. It may be early days. Jio, on the other hand, is suffering from multiple things. They've increased prices. They've seen demand falling. There is a potential competition coming in from Starlink, which continues to get that license to operate in skies. Of course, I don't think it'll be as fast in terms of speed, but it'll be an alternative. So they will be that weighing on investor concerns. And the whole oil and gas prism kind of plays according to global refining margins. And to that extent, we have not seen anything majorly positive in the last quarter and possibly in this quarter also. Of course, if things change after the presidency in the US changes, maybe crude prices cool down even more, that might actually help some of the margins. But I don't see that meaningfully change for now. So, you're going to have some problems right now. I think these are all interim and temporary problems. Over time, all the businesses are going to be useful for them. So I think there's going to be more patience required. I mean, if you've been patient, you've kind of had to be patient for a long time already. But I still think the next 5 to 10 years, this company should do very well, especially if it's demerged into 3 or 4 entities after this.
Deepak, hi, afternoon. There's another one which I think you track closely, LIC. LIC, of course, reported numbers on Friday evening. And let me just quickly go across to Yash. Yash is highlighting this JP Morgan note, which is, in sell-side language, double upgraded their rating. So from underweight, they've gone to overweight. Yash, but what's the thesis? And numbers were strong, and you said that on Monday morning as well. Tell us.
Well, Prashant, you rightly pointed out, we had discussed that the numbers for LIC in the second quarter were very, very strong, and that's become the thesis for JP Morgan's double upgrade as well. They've upgraded the stock, as you said, to overweight from previously underweight. And also, there is a very sharp increase in the target price that they've made, going all the way to about 1,075 rupees per share from the previous target of 790 rupees per share. As I said, that the growth in the second quarter was very strong. JP Morgan alludes to that growth, saying that they feel that the growth is expected to sustain itself going forward as well. In terms of taking that growth precedent, they've revised their FY 25, 26, 27 estimates on VNB by 9, 11 and 12% respectively. Qualitatively about the book, what they have to say is that the product mix enhancement is likely to outweigh negatives coming from higher product benefits. That is the surrender value, higher surrender value which came through, and lower bond yields. Second thing that they say is that the non-par book could sustain on new product side. Of course, the improved results were because of the higher proportion of non-par in the total business. Also, what they've said is that the impact of the surrender value regulations is likely to be very minimal on LIC. There are two risks which JP Morgan has pointed out. One is weaker margins in the par segment, and the second one is moderation in the mix enhancement. On the valuation side also, JP Morgan says that LIC trades at 0.6 times FY26 estimated price to embedded value versus its peers who trade anywhere between 1.8 to 2.4 times price to embedded value.
Okay, Yash, thank you very much for that. Deepak, do you have, I'm maybe mistaken, but you own LIC in the portfolio?
Yeah, very big position here again.
Yeah,
We've held it for a long time, but you see, their embedded value is like 821,000 crores, and their market cap is 580,000 crores. They're 0.7 times embedded value. In comparison, HDFC Life is probably 2.5, 3 times more. ICICI Pru Life is also about that range. So we're talking of a very large differential between the largest private sector, public sector insurer and the private insurers. And here's the beat. In the September, in the month till October, actually, you've seen 22% growth in new business premium overall numbers for LIC versus only 12% for the entire private industry. So they have regained market share quite remarkably as well. There is a problem in the accounting that creates an issue with the way the numbers are. So their solvency ratios went from 1.9 to 1.98. So they've earned more premium, but retained it at the policy holder level rather than transfer it down to shareholders. Remember, they need only 1.5 times as a number instead of 1.98. So they have a very large buffer between what is required and what they currently have, and eventually this will flow to shareholders. If not today, then at some point tomorrow. This is a fairly large cash earning machine, so it should be generating of the order of, in the last quarter, there's going to be a significantly higher profit bump because the participating policy share comes to the shareholders only in the last quarter of the year. The rest of it will be 7,000 to 8,000 crores per year, and then the last quarter is generally higher. They've moved their non-participating share to now about 20% plus, which is what they said they will do in the IPO. And that adds a lot more revenue going forward to LIC shareholders compared to policy holders, because non-participating is where you don't have to share the profits earned by the investments to the policy holders. It's any extra profits roll down to shareholders directly. So given LIC's positioning, I think we're very positive longer term here. This company should hopefully give us great returns. There are short-term negatives. The government will have to sell some stake at some point to bring it down to 75%. They're at 95% plus or something. And at some point, the insurance industry is going to see some level of consolidation. So LIC may be required to participate in that. These are negatives. But by and large, I think the result is quite good. It may not look so good from an EPS perspective today, but overall, I think from a premium growth and market share perspective and participating, becoming a lower and lower part of the overall offering, I think, long term, this is going to be a much better insurance company than it was in the past.
By the way, check Zomato. Zomato, in a otherwise subdued, falling kind of a market, has actually made very quiet up moves from the recent close. It's had a good November so far. The stock's up about 8%. It's put on about, I think, 5%, 4.5%, 5% just in the last 2 days, Monday and Tuesday. And it has been on a bit of a recovery path from the lows at the end of October. Now, we all know that Swiggy's listing is going to happen. It could be as early as, I think, before this week goes out. The IPO went through. So that's the question, really. What would you say, Deepak? Would you be a buyer of Zomato? I don't know if you participated in Swiggy or not, but between these two, which one, both, or neither?
So, Surbi, we can't do IPOs because as a PMS, you can't participate at an IPO level, but you can buy in the market afterwards. Typically, an IPO require, after 6 months, you can see almost all the IPOs. You see the institutional shareholders who were VCs earlier start to sell their shares and therefore bring the price down. You're seeing it with Ola Energy. You have seen it in the past with Zomato. You have seen it in the past with a bunch of other VC-funded startups that went public. That the selling pressure that comes from these VC shareholders who want to exit creates little buying interest because a lot of players know that there's going to be all this selling that's coming up. So we might wait those 6 months while the company then announces results publicly before we attempt to take a large position into the stock. We used to have Zomato, but we got out. Both of these companies have a risk that their quick commerce operations may have an ED inquiry going inward towards the ownership of the inventory in their dark stores, which is a possible cause of concern in the longer term, because at some level, the control on those operations, if it resides in the Zomatos or the Swiggies, you will have an issue with the ED coming back and saying you're not allowed to own inventory because you're foreign owned primarily. Zomato's trying to solve that by doing I think there's a secondary QIP that's trying to, or as a primary QIP that's trying to happen, that will make it less than 51% foreign owned, which will solve this problem for them eventually. Swiggy will probably have this problem a little bit longer. Now, let's see how this evolves. I know I hate to say this because it's so boring, but wait for 6 months before you make those decisions on at least a Swiggy. I think the ED thing is an overhang for both the players.
Okay, all right. So let's see how this plays out and how the regulation also moves when it comes to quick commerce. Thank you for this, Deepak. Always a good conversation. Really appreciate you joining us on the show today. We do need to take a quick break on that note. As we do that, here's a reminder. As CNBC-TV18 celebrates 25 years of excellence, we invite you to the most anticipated event of the year, the CNBC-TV18 Global Leadership Summit on the 14th of November, starting 10 a.m. A power-packed day with several panels focusing on India's economy, digital landscape, markets, entertainment, and a lot more, only on CNBC-TV18.
Welcome back. You've got the market, which of course is still down about 200 points. 23,943 is where we are at. Jitendra Gohil is with us, Chief Investment Strategist at Kotak Alternate Managers. Jitendra, good to have you with us here. Thank you for your time. In terms of variables that you are watching, which will determine direction for markets from here, Jitendra, what are the top 2 or 3 things? There's of course earnings, there is a selling from FIIs, but you also got this very strong trend now developing in the US dollar, which is, putting pressure, of course, on Asia Forex, rupee, CNY, etc. How big a factor is that? And just, to your mind, what are going to be the dominating drivers? And what's the view which is forming at your end? Are we close to some sort of a trough? We've broken 24,000 by about 50 points or so today, this afternoon, or there is more to go?
Hey Prashant, hi. Thank you for inviting me on your show. There are several questions, so let me just quickly, answer and put some perspective about what we think about the Indian equity market. So markets are generally driven by valuations and earnings. So obviously, you mentioned the earnings cut is a bigger worry in my view. I think what we have seen for FY26, the earnings growth is still a little bit optimistic. It might come down further. So in that view, I think market will remain a little bit subdued from earnings perspective. However, valuation is pretty challenging subject. I would say that, look, the bigger challenge for India is a stronger dollar and how Donald Trump's policies are going to spark inflationary worries in US. So what we're hearing is like, look, if Mr. Donald Trump goes for higher tariffs on imports and also give a lot of incentive for corporates to invest back in US, that will lead to significant inflationary pressure in future. Now, 2 ways to look at it. If there is inflationary pressure in US, then definitely there is some offsetting factors that should be on play. Otherwise, inflation will run out of hand, and that will lead to significant trouble for the economy. So one way the Trump government can control inflation is by cutting budgets. So probably the fiscal deficit, which is running in US at around 6-7%, will have to come down because the debt to GDP in US is around 125%, and every 100 days we hear that the debt level in US is going up by $1 trillion, and today the interest cost to service that debt is around $1 trillion per annum. So I think US actually is in a difficult spot as of now, that they have to control inflation, they have to control interest rates and the kind of problems that they are facing on the debt side. So one way to do it is to cut budgets. So probably government jobs will be cut in US, or we might see the commodity prices, right? So if you're not able to control inflation domestic, what you do is try to control the commodity prices, and hence I think Donald Trump's policies is also to mine more infuse mining activities, also drill more oil, sanction or put more tariffs on China so that the global inflation comes down. So I think there will be a kind of a confluence of factors which is going to impact the equity markets globally. However, one thing one has to understand in this kind of scenario, we are not alone. I mean, if you look at the global as a one market, if US does not do well, even our economy, Chinese economy does not do well. And the other way around, if the global market does not do well, even US will not do well. So tariffs, I think, should be measured, but I think market is now taking a cue that, look, there will be a tariff war, and hence I think market is a little bit, sentimentally taken a backseat. One has to observe how things pan out. From India perspective, I feel that the impact on Indian market will be limited, or I would say that the relation between US and India was actually very good during Trump presidency. And now again, when Mr. Trump is back as a president, I expect that both the countries will find some solution. So there's talks of FTA, free trade agreement with US is ongoing. I don't see that get signed so soon, but certainly there are some industries might see some kind of incentives. So India will have to definitely open up. It will be a transactional relations. So certain sectors which are going to compete directly with US companies in future, I think one has to look at what policies US is making. So net, I feel that market is corrected 9% and earnings cut is almost in that level. So as of now, we haven't seen valuation correction. So in my view, I think once the interest rate starts moving up in US because of inflation worries, there could be more pressure going ahead. Hence, one should remain a little bit cautious in the near term. However, we think that government spending is going to go higher in the next 3 to 6 months. And hence, we think that the earnings growth may start to come back. Hence, we are a little bit optimistic from a medium-term perspective.
All right. Hi, Jitendra. Good afternoon and good to see you. And just request you to stay with us. Sambadara Madison, the numbers are flashing you on the screen. On the top line, there's a small miss. The margins as well have come sub that 9% odd mark, which is lower than what we're working with. And that's further percolated down to the net profit numbers. So the initial look at the numbers on Sambadara Madison, it goes down as a bit of a miss. We'll try to get more clarity on this front. Well, Jitendra, how you are placed on autos? You had Bajaj Auto. After a while, it got, disappointed. We had Mr. Rajiv Bajaj try and clarify things. And from Maruti as well, you have a mixed outlook that's coming in there. How are you all approaching this space? Because, there is a bit of a slowdown that we're talking about domestically. The international market as well is in a bit of a tizzy. And there are various pockets where we're seeing supply side issues that still exist. So your approach?
Hey, Nigel. Hi. Yeah, we spoke last time about auto and we said that one should cut exposure and sell auto companies. We still maintain that view. We think that large part of inventory built up ahead of the festive season is over. Now it's the time that the retail inventory should get cleared up. And we think consumption overall has been a little weaker than expected. Hence, I think there could be more pain in the auto sector because the kind of growth that these companies have delivered, as well as the consumption weakness, I think the base is high. We should see more correction in our view, and hence we are staying away from the auto sector to some extent, even the auto ancillary companies. Except in this space, we like that CV space, CV financiers could do well in Q4. Generally, in the March quarter, we see that CV cycle sees some kind of uptick. I think December to March quarter could be better for CV relatively compared to other auto companies, and hence we are buying some of the NBFCs which are financing CV space. Otherwise, we think that the sector is going to see more valuation correction as the earnings are not going to be delivered to the extent market is forecasting.
Jitendra, hi. Good to have you on the show. So I guess the problem with our market is that different pockets have been hit by different issues all at the same time, right? BFSI, the RBI has been talking tough, whether it's unsecured loans, credit deposit ratio, gold financing. So that's where the slowdown is coming in. Export-facing sectors like IT, they have enough on their plate with the US election, etc. And then you have the domestic consumption story, which is under a bit of a question mark as well now, right? So just let's focus on earnings. And you spoke about this 9% drop. Now, earnings have started faltering even before any adverse tariff action comes in from large countries like US or China, etc. What have you made of the earnings slowdown? And you said that the valuations still haven't corrected as much. So how much lower for this market then before valuations get attractive?
So Sulbi, there are a couple of things that we have to take into account. One is the structural growth story for India, right? So that remains intact. In fact, we have been writing that, look, market is going to see pleasant surprise in coming years that India's structural growth story has actually strengthened. And we maintain that view. This is a macro blip for a quarter or two. We think that this is primarily because the government was supposed to spend 17% higher on a year-on-year basis on capex. Year to date, they have actually spent negative 15%. That is, there's a drop in government spending. So such a massive cut in government spending is actually perplexing. And I think you can give reasons because of elections and monsoon and so on. But I feel that, look, this is a blip driven by a massive cut in government spending, both on capex as well as on the revenue side. But once the Maharashtra elections are over, we think that the real estate activities will pick up, which is a major contributor to economic growth. Plus, the government spending can go higher. And hence, we think, again, those stocks which are backed by government spending will start to see some uptick. Right? So we think in the next 6 months, the government spending will accelerate. Monsoon was better, and hence the reservoir levels are good. I think it is higher by around 13%. So the Rabi crop season expected to be better. The food inflation will come under control, and at least in Q4, the couple of months it may spike, but in Q4 we expect that because of better Rabi crop outlook, the inflation is also going to come down. So in that perspective, we think that we have already achieved or already gone through the tough period from an economic growth perspective. And at the later part of the festive season, we have seen it pick up in sales and economic activity. So net, those sectors which are exposed to government spending will start to come back. Look at the defense. Some of the defense companies which have written phenomenal margins. Obviously, we don't recommend that because of higher valuation, but from operational perspective, these companies have reported decent numbers. Look at some of the hotel companies, right? In the next 3 to 6 months, the outlook is very bright. I think that segment is looking pretty attractive at this point of time. So I would say even PSUs, some of the PSUs have come out with a very strong number, even better than some of the private banks. So I think some part of the sector which has corrected and they have delivered better earnings growth. I think that pocket is looking a little attractive. Now, to come to your question, where the overall outlook or overall valuation will stop, I think, we are trading somewhere around 20-21 times P ratio. India's average, before COVID, because COVID had led to some significant spike. If I average it 10 years before COVID, somewhere we were at around 17 times P ratio. So we are 3 points or 4 points higher. I think if I look at the ROEs, which have almost 8-9% to almost 14-15%, debt to EBITDA was around 3x pre-COVID. Today it is less than 1 times. Our current account deficit was around 2%, and as we speak, we are below 1%, and even will go down or much faster consolidation there. And fiscal side, we all know that we have been continuously surprising on the upside. So from a macro stability perspective, rupee has been extremely stable despite it is touching all-time low. So I think all these things says that, look, valuation is not going to correct significantly from here. It is the earnings-led correction once, and also the flows. I think FPIs are actually a little bit nervous because dollar is strengthening. Once that abates and how much they can sell, some sooner or later there will be a fatigue in selling Indian equity. It's already reached to around 16% of BSE 500, which is 13-year low. So I feel that large part of FPI investments, which are active, FPIs have seen sale off. Probably another, couple of months we see this kind of problems. But then I think we should look at stability in the market, and then from there onwards, the earnings will have to catch up as the economic momentum will pick up.
Got it. All right, Jitendra, we'll leave it on that note. Thank you very much for joining in, and you have a good rest of the day. Need to take a very quick break on that note. We'll come back on the other side with D Street chatter. Let's see what is coming up on Nimesh's radar today, and then some final trading calls coming up with Mitesh as well.
Welcome back. Well, in the last few minutes, the markets actually have taken a leg down. And a few stocks that have pulled back a little bit more. You have Coal India that's moved a little bit lower. ONGC as well has moved lower. SBI, the numbers weren't bad, but actually the stock has only been moving post that. So all these three names actually have moved lower. The Nifty Bank itself is down 750 points. We were down 200 points, but now that incremental 50-60 point fall is what we're seeing on the index. Good time to get in. Nimesh, tell us, how are you reading the data points today? And is it the flows that is causing, this kind of a fall?
Nigel, yesterday's number gave a bit of a glimmer that maybe that FI selling is coming towards an end. And maybe, that's too early to read that, because again, the sense I'm getting is today there is FI selling and it's intensified, especially in the second half. Once the Europe opened, we saw a big cut in the large cap names. So again, the buy side ratio, my indication is it's close to 1:2 on the sell side. So again, the net number will be important to track. And that's something to, will have an impact on the overall sentiment as well. But I guess technically too, we've broken the very crucial support of 24,070 on the Nifty. Yeah. If that now, and that was a feedback as well. If that gets taken out, you might see a bigger cut in the Nifty and in the bank Nifty, and that's maybe showing up in today's fall as well. The challenge now is technically the next big support is only around 23,500. So another 400 points can easily, can get knocked off. So that's a technical view, but from a flow perspective, it looks like there is selling from the larger FIs today. And I guess, the sharper reactions to the earnings continue. We saw big cuts in likes of Britannia, and a lot of numbers which came even during market hours have not been very supportive. So again, that's coming to a fag end of the earnings season. So that bad news is going to end maybe next week. But I guess the FI number is something to track very closely. And again, looks like from the feedback that I've picked up today, that selling is intensified, at least in the second half.
Well, let's see whether or not we get another time lucky, because at 23,800, the markets have bounced back twice. So let's see whether or not we get the third time lucky, or in fact, this time we break it and move to the 200 DMA. What about individual stocks? What are you picking up?
So a lot of names in the overall market have done well despite the sharp fall-off. For instance, Trent has recovered sharply in the last couple of days. Even the volumes are on the high side, and I understand a leading domestic mutual fund has been an aggressive buyer as well in Trent after the recent correction post the earnings. So that's the first name. The second stock is Macrotech Developers. Weak market, that stock is up 4%. The volumes are slightly on the higher side and looks like some bit of buying interest is back. So expect high delivery volumes, and there are buy flows from larger FIs in Macrotech Developers today. The third stock is CE Infosystem, the MapMy India. That stock has been under pressure post the Q2 earnings. For second day running, I understand there is aggressive selling from larger FIs in CE Infosystem, which is MapMy India. And the last is Max Healthcare. There I understand there are block bids been shown by a lot of FI investors. So there is buying interest from larger institutions is what I understand. And again, additionally, I understand a long only fund has been an active buyer of late in Max Healthcare. So that's the last name on my list.
Nimesh, thank you very much for that. So those are stocks which we need to watch out for as things stand right now. That's heard on the street, D-Street chatter. Mitesh is with us with what to buy or sell today for a reverse trade tomorrow. Mitesh, first, of course, a word on the fall that we're seeing, which is accentuated.
So Prashant, I think, as I said, this time it does look like, breaking the 24,000 meant that we might head towards 23,850 practically there. And below that, I think everybody has highlighted this. The 200 areas on 23,500, 550 area is the next support area. So I think we are heading towards that. In that sense, we would suggest traders to carry on to their index, their spreads or put spreads if anybody has made them. And on the stock side, I have STBT on BHEL. That's the stock which is now near the day's low. So STBT with a stop at 232.5 for targets of around 225. The downside can be looked at. And the other stock which I have is STBT on Dabur with a stop at about 514.5 for targets of 502.
Okay, all right. Thanks a lot for that, Mitesh. Well, let's focus on a couple of stocks, at least that are holding in the green. Ramco's numbers, well, they were good. The operational performance was good. And what helped them was a couple of factors that played out. So the reason for the EBITDA number to come in higher was that the sales volumes degrowth was less than expected, point number one. The second factor was costs were lower than expected. So if you look at the power and fuel cost, well, that as well did see a sharp decline. Remember, the management has been talking about the stress they're making on using a high amount of renewable energy. the cost of blended fuel consumption per ton came down to around $130 per ton. That compares with around $148 per ton. And as on date, it's even lower. So, they'll get some cushion going ahead as well. Remember earlier that wind power was used to sell it out to the open market. Now they're using it captively. So that's what's helped in reducing the total cost of power. The cement capacity has moved up marginally, and they're saying going ahead it's going to be moving to around 30 million tons odd. Remember, for Ramco Cement, what works is they add capacity at very, very minimal capacity, minimal capex. In fact, for the past quarter, they added capacity at less than $10 per ton. We're talking about grinding capacity, so it's not integrated, but still, it is at a relatively lower cost. The debt is sitting at around 5,000 crores, but the management says that they promised that they'll do 1,000 crores of non-core asset sale, and they've already achieved 350 crores or thereabouts. So put all this together, the street is pleasantly surprised. Ramco Cements, after underperforming, well, it's seeing a bit of a relief rally in today's trading session. But let's focus back on markets. Jay Bala of cashsecures.com joins us on the show. Hi, Jay. You must be a happy man. You told us last time around, Nigel, this rally that we're seeing, it's going to get sold into, and we're going to test lower levels. How low can we go? What are the levels you're looking at?
Hi, Nigel. Good to be here. Thanks for the acknowledgement. Now, see, the market is doing what is anticipated of it, and I still hold the view that what I said on October 1st, that this market is correcting at least to the June 4th low of about 21,830. So that remains unchanged. But what happens at the intermediate levels? Where are the intermediate stops? That's the only question. So as I pointed out last time, the 23,816 support that it took last week, if that were to go, the next support comes at about 23,650. And below that, it's 23,100. So I don't anticipate at this leg. I mean, in this leg, the market to drop straight to 23,000. I anticipated some bounce to come through from 23,600 and change. But if the market were to break below 23,600 and change, it signifies that the markets are more weaker than I'm anticipating. So we want to see some bounce come through. And I think I'm anticipating some bounce that's sizable than what we saw from 23,816 to 24,500 and change. Maybe the next bounce could be slightly larger than that, but the market remains sell on rise.
Also, Jay, hi, good afternoon. So you're saying that you will sell even that counter trend rally, which you are expecting can happen. Then what? I mean, what are the levels below 23,800 that you would perhaps even track? I mean, a lot of people are talking about the test of the 200 DMA. So how are you sort of going to play along with this?
Yeah, the theme remains sell on rise until markets find support at significant levels, but that's still not happening. There is structural breakdown for leading indices that were leading the bull market, and capital goods index is at an important support. The nifty NSE 500, the nifty 500 stocks are at a very important support for a long-term trend line from 2020. And if it were to close below 100 points below current levels, that will be the breach of a trend line. So that will signify a long-term breach and the breadth deterioration for the market. And so, the strategy remains sell on rise. As I pointed out last time, Nifty Bank probably is going to be, the leader on the way down this time. And if Nifty Bank were to break below 50,380, that will be a breakdown from a head and shoulder stop. And that will lead to a fall somewhere close to about 45,000, maybe a little more lower.
Jay, hi. And again, congratulations on getting that call right. The dollar, Jay, if you can weigh in, it's a sharp move and a relentless one. From this morning, 8 o'clock, we've had another third of a percent move higher, closer to 106 now, the dollar index. What's your sense?
Yeah, 106.119 is an important resistance. If that gets taken out, we are likely to see much bigger levels to come through. I've upgraded my price objective for the dollar to at least 109.5. So, I had earlier projected about 106.5. Now I'm upgrading that to 109 and change. Along with the dollar, the yields are also rising. The most important thing that's happening for the market is that, if you look at the US consumer price inflation and compare it, the 2020s consumer price inflation with the 1970s consumer price inflation, it's been moving lockstep. Unfortunately, I don't have a chart to present in front of you for the viewers, but Arthur Burns, the Federal Reserve Chairman in 1970s, did a similar thing, cutting rates from 13% to somewhere close to 5.5% when the inflation had risen up to about 10%, which is similar to what the user consumer inflation rose up in 2022, and now it's dropped to manageable levels about 2.5 and change. The Federal Reserve is very possibly committing a policy mistake by cutting interest rates. We're going to see a resurgence of inflation come back. That's what the dollar index, the yields are actually pointing out to. This is regardless of Trump implements his policy of tariff rate cuts, because I'm seeing Brent crude drop to just below the September low by 65 and bottom out and begin a move somewhere close to $100. So regardless of what Trump does, Brent itself is going to bring in a lot of inflation.
My, $100 on Brent. Wow. I guess, but that's what markets do. They surprise you when you don't quite see the immediate future. It's always in the distance. That's an interesting call. Jay, stay on. We have to take a break. We want to come back and discuss some more individual stocks with you, some more trades that one can perhaps look at. Back with that in just a moment. And as we take a break, here's a programming note. As CNBC-TV18 celebrates 25 years of excellence, we invite you to the most anticipated event of the year, the CNBC-TV18 Global Leadership Summit on the 14th of November, starting 10 a.m. onwards. A power-packed day with several panels focusing on India's economy, digital landscape, markets, entertainment, and a lot more. Only on CNBC-TV18.
Welcome back. No signs of a recovery on the Nifty. We're still down 270 points at the low point of the day. Hyundai Motors, they're in focus. They reported a muted set of numbers in the second quarter. Sudarshan joins us to help us out with more details on that. Sudarshan, take it away.
So like most of the other four-wheelers, Hyundai has come out with the earnings which look muted. And mainly it was because of the fall in the volumes that company has seen both sequentially and year-on-year. Volumes are down. On YY, volumes are down 17%. Sequentially, if you look at, it's down 1%. Even realization is flat both sequentially and year-on-year at rupees 9 lakh. So it looks like that raw material cost, like increase in raw material cost, company has failed to pass on to customers. Also, two reasons that company has mentioned. For domestic demand, company says demand was impacted by cyclical and seasonality. And for exports, it says Red Sea had an impact on the export segment. Talking about the headline numbers, profit was down 16%, revenue has fallen 8%, EBITDA was down 10%, and margin has come at 12.8% versus 13.1% the same quarter last year. Now talking about the segments, like recently we have been saying that SUV has been, the contribution of SUV has been increasing in overall volumes, and that's the reason for Hyundai also, contribution of SUVs now has increased to 70%, which is up 400 bips, and hatchback and sedan contribution have come down by 200 basis points and 100 basis points respectively. And commentary company say it expects sustained demand momentum in medium to long term. Also, it will continue to focus on quality of growth. So earnings are largely muted and below estimates.
Got it. Thanks for that, Sudarshan. Jay, coming back to you, going by the way you're looking at the market, I'm guessing if I ask you for stock calls, it probably could be on the short side. Give us your ideas.
Yeah, I have two calls for today, Nigel. One is Glenmark. Glenmark is breaking down from a head and shoulders top, and the stop loss is about 1777. The neckline break happened today, and the price objective works out to about 1400. It could do a little more. For the first time since 2020, I'm turning bearish on the pharma sector. So that's probably a trend change there for the whole sector. And the second call is on the banking index. PNB, the recent bounce from the October 25th low, looking like a corrective bounce. Hence, the high of 108 should be used as a stop loss, as unlikely to get taken out. So, a price objective of 92 for PNB. Canara Bank also looking pretty similar. You can use the high of 2-3 days back and expect it to break below the low of October 25th.
Now, the fall is quite a big one, you'd have to say, 280 points down. And again, it's one of those days where buyers are simply not emerging. Then they're unable to withstand the onslaught of the selling pressure that's coming through. Look at that. I mean, it's just low after low after low. That's the kind of day that we've been in the midst of. And remember, the lowest point of our consolidation, this about 700-point consolidation that we've been in the midst of, it's 23,816. And we're practically there now. Just very quickly, Jay, are there any places to hide, any counter uptrend rallies that you'll trade on the upside, or anything that relatively looks stronger within the Indian market?
I'm watching a couple of names, Surbi, but I'll wait for the market to produce a reversal. Bharat Electronics actually, broke out of an inverse head and shoulders pattern, and if it were the right environment, it should actually go to record highs. It should not break below 277. If it does that, it will negate the pattern. Likewise, I'm watching one more low to come through for sugar 11 futures. But that's actually a corrective decline. Once that happens, I'm anticipating sugar futures to rally to somewhere about 24 cents per pound. So that will probably bring in a rally for the sugar stocks. But it's still got a little more downsides to work with. So these might be places to hide, but that will be just for the very short term. I don't think it's for the medium term.
Okay. Thanks for that, Jay. Good to get that sort of perspective going. We are down to the last 1 minute of trade. So let's quickly recap the action. Weak. There's no other way of putting it. 300 points down on the Nifty today. A bit of a crunching fall. 23,850 is roughly where the Nifty is going to be ending the day. It's a vast sea of red, really. Look at Britannia. After losing 5.5% yesterday, there's a 7% drop on the counter today. That's the extent of the disappointment regarding those margins. Stocks like BEL, NTPC, State Bank of India. So a lot of these PSUs have not had a good day. Counted a Power Grid as well. So PSUs not unscathed. Coal India is also down about 2%. Asian Paints has lost another 3% after yesterday's 8% decline. There are the likes of Tata Motors, Bajaj Auto, Maruti. Lots of selling in these auto names as well. Really nothing, as I'm saying, has managed to survive the onslaught of the selling pressure, barring maybe a trend. And it actually ends there. Even IT stocks, which in the first half of the session were having a better run, towards the end, a lot of that fizzled out. TCS, for instance, is negative. Infosys is completely flattened out. So not much to talk of when it comes to the gaining side of the screen today. And mid-caps, Prashant, even worse because the advanced decline ratio is extremely negative for now.
Absolutely. And I think it's not looking good at all. I'll just mention a few more names where, there was selling. Look at something like a Borosil Renewables, sharp cut. Akums Pharma, 10% lower. This BASF, which is a MNC, 14% cut on volumes, by the way, mind you, on the downside. BASF will also come up. I think Jyoti Laboratories is another one which was down sharply. Rate gain. There was a guidance cut and the stock ending almost 10% in the red. That's a travel SaaS company. You had, Piramal and Motherson, etc., are other 10% losers that we kind of highlighted earlier on. On the upside, apart from I think what we've mentioned, there was HBL Power, which was a gainer from the morning with decent-sized volumes. I think there was Newland Laboratories, which was up sharply. And Lodha is making a bit of a comeback. It's already bounced from the lows of about 1,050. And it, of course, did not sustain at the day's high. But it was, a decent day, otherwise down and out market. Oh boy, 300 point, triple century on the downside. 23,840 is where we finally ended the day. And I think that actually the day's high today is 24,240. This is a very large cut that we are talking about from the day's highest level for the Nifty and, of course, for the other indices as well. Bank Nifty was down, but PSU is really putting a fair bit of pressure. Both the PSU Bank Index and the CPSE Index, the PSE Index, saw that selling pressure come through. Well, it's a wrap on this edition of Closing Bell, but stay with us because we're going to come back after a quick break and take up the action as far as markets forward go. Stay tuned.